Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw. I'm a senior market specialist at FXCM. My email address rshaw@fxcm.com, and today is Tuesday, the 8th of March, 2022. I'm just going to bring up our high risk investment warning. I'll keep this on screen for a few moments. This morning's review will be kept fairly short. Unfortunately, there's no power in my area. So I'm working off just the laptop battery at the moment. And here's our market commentaries disclaimer. And just finally our references, MarketScope, CNPCM, possibly Trading Viewer, or though I doubt we'll move to Trading View. Let's just go through the morning market note with CNBC. European markets set to fall further as Russia-Ukraine fears persist. European markets are set to pull back on Tuesday as the prospect of a slowdown in Belarus have made progress in abating the escalating war, and investors remain skittish after the US revealed active discussions with European governments about banning imports of Russian crude oil and natural gas. Such a move could pose a risk of stagflation, a period of slow economic growth and high unemployment, coupled with high inflation for the global economy. We discussed that yesterday. The news sent oil prices to 13-year highs, though they gave back most of these gains throughout Monday. International benchmark prices for crude were up above 3%. Ukraine's Defense Intelligence Agency claimed on Monday night to have killed a second Russian general near Kharkiv. Intense fighting has unfolded in recent days. Mainland Chinese markets led declines across the board in Asia Pacific on Tuesday, while US stock futures indicated further losses on Wall Street later today after the S&P posted its worst day since October 2020 during regular trading on Monday. Well, so clearly still a risk-off sentiment. I just wanted to reference the oil market. Here we can see the gap open, so it gapped. Here's Friday's close, here's Monday's open, and we're kind of seeing if we are having a runaway and an exhaustion gap. By the way, the possibility of a runaway gap is very real, and not only is it due to potential bans on Russian oil, but it's unilateral action on Russia to stop supplying oil as well. So there's a risk sort of running both ways. We're just going to have to keep an eye on this. It's not a normal market move, but we're not in normal markets, and we are overbought. But because we're not in normal markets, we can stay overbought for as long as the emotion is heightened. So it's making the analysis extremely difficult, as Pete said yesterday. Let's just take a look at the DAX here. Before we go to DAX, okay, so here's the runaway exhaustion gap. One of the key metrics for us is gold. Okay, that's going to be really important for us to understand what's happening with the markets. And when I turned on my system yesterday, we had a candle like this. Okay, so we basically had a doji yesterday. In other words, the markets opened sort of with a gap up, moved down, and then was flat. And at the same time, the gap in the oil market had started to close. But now oil's on its way up, gold is on its way up, so that the haven scenario is still very much in play. Again, we've gone overbought, but we're at heightened emotions, making the likelihood of staying overbought for longer it's making it more probable. So we just got to keep an eye on that. The risk of stagflation is a real risk. The idea of cutting off imports from Russia, to me, would seem less dangerous than Russia just cutting off their oil exports. The reason is, I think that Western economies will phase it out as they build up other sources. So there's real risk here for that stagflation that we spoke about yesterday. Let's just go through to the DAX. Hey Katie, good morning to you. Nice to have you on the webinar. All right, so what we'll do here is we'll just look at it as follows. I'm going to bring up dual screens, and we've got the DAX weekly. I'm going to put the DAX daily on the side, so we kind of can see what's happening here. All right, so on the weekly side of things, we've got the lower peak followed by the lower trough. This is a bear market. By classical definition, this is this is a downtrend. Okay, we are getting to a point where again it looks overdone. Okay, what does that mean? Can we start looking to exploit potential overshoots? And I would still be reluctant to do that because of the heightened emotion and the threat of extreme action in terms of causing stagflation. In fact, what we can do here is we can add in the stochastic. Let's do that. All right, so in fact, let's take out the percent D. We don't need the percent D. All right, so you can see that we are in now extremely dangerous territory for markets. The longer we stay in that lower quintile, the lower the pressure. And even if we get some sort of normalization here, okay, but it stays below 50 and the stochastic stays below 20, we're likely in the bear market. So let's just take a look at the daily. Again, the daily chart's overdone. Will it correct? You know, the idea is the RSI is subject to the Pareto principle. The Pareto principle says it stays within normal boundaries 80% of the time. It stays at extremes 20% of the time. So we would typically see some sort of normalization in the RSI. Again, just stress the sort of twilight zone factor. You know, the factor where it just absolutely abnormal, strange trends can potentially take place. We've got an inside period at the moment, so let's just take a look at price action over the last few days here. So we've got a big red candle down here. This is Friday. Here's a gap down on Monday, and it's got a lower high, lower low. So the downtrend continues. Right now, this is an inside period, so we've got a higher low, higher, high low, lower high. Investors haven't yet started taking down price lower. They're uncertain, and the reason they're uncertain is because of we are in this extremely uncertain environment. How are the Russians going to act? How is the West going to act? What is their combined actions going to do on the market? how is the tensions and the geopolitical escalation and the just outright invasion of a sovereign going to affect the markets. And the idea here is these are unknowns. That makes it hugely uncertain. Well, that's the very definition of risk in the financial markets. We are right now in a high risk market environment. There's no getting away from that. High risk means high return. Everybody focuses on the return. The truth is you've got to focus on the risk. Okay, so we've got this uncertain candle here. Let's just go down to the hourly. Let's use this one. All right, so if there's going to be any normalization in the RSI, if the investors are going to find support here and start, or traders, let's call them market participants, in fact. So if market participants are going to find support here, well, on the hourly, what we need is for the EMAs to cross over and move northeast. We need the stochastic to cross over, head towards 80. Okay, at the moment, neither of those have happened. In fact, the stochastic is in the lower quintile. The longer it stays in the lower quintile, the greater the chance that we see a lower low here. Okay, so angle and separation in the EMAs, movement towards the lower into the lower quintile. That to me would promote DAX weakness. All right, I'm going to ask for the stochastic on the daily. We can put that in. We can certainly put that in. Here we go. I would imagine, Anna, that it's going to show us a position in the lower quintile. And the reason we can see that, just before I bring it in, is remember the formula. We're looking at the close relative to the range, so it's going to be extremely weak here. Let's pop it in. Let's take out the percent D. We won't need it for the daily analysis. And you can see that it's in this lower. I mean, there's no doubt about it. We are in an extremely weak market. Stochastic-wise, the momentum on the daily, the weekly is down. But in terms of the the change in Y over the change in X, what I'm saying, the rate of change, okay, the speed of the price, the change in price of the change of the time period, that's too fast. We've got an oversold market. The market has gone down at a rapid pace. Bear markets do that because of the just the strength of the emotion of fear, and ultimately, what's going to end up happening if we're not in the panic selling stage yet, and I think we can argue that we are, but that panic selling stage is going to move into that renewed confidence stage. That's where all the bargains are. But right now, I think we're kind of in that panic selling stage. But if we're in that panic selling stage, life is going to be very, very difficult because of that uncertainty. So the stochastics are weak. I think for traders, take a look here. Okay, this is the hourly chart. Stochastic stays in the lower quintile. Price declines. Okay, which makes and we've done the formula for stochastic previously, it makes sense. Even the oversold conditions here, whilst they prompted some sort of pause, it's really the stochastic staying in the lower quintile that does all the damage, isn't it? Well, we're not oversold in the hourly, and we're in this lower quintile. We're in a seriously weak start to the day. So, and you can see the EMAs are starting to, or they're looking to get angular separation. The market's going to open in about just under 3 minutes. But that angular separation to the downside, stochastic staying in the lower quintile, That's bad news, and that means weakness persists. You see that weakness on the daily, you'll see it on the weekly, but we're oversold. But because this is a bear market, the fear is just overriding everything. Okay, the sentiment is risk off, and we continue to monitor, acknowledging, and this is the big deal, acknowledging we are in a heightened, uncertain environment. Uncertainty, that is the very definition of risk in the financial markets. So we're in a highly risky market. High risk equals high reward. Everyone focuses on the reward. I'm suggesting focus on the risk. Okay. Is it too late to get into a gold trade? You know, you're not going to like my answer. The answer is it depends. You know, and the reason that I can't sort of be more there's two reasons I can't say more. First of all, I'm obviously not licensed to give advice, but the second reason, and the honest reason, is I just don't know. We're in again a highly uncertain environment. If the stagflation scenario continues to become the obvious path, if the odds for that stagflation tend to improve, then I would suggest gold has still got a long way to go. It's the obvious choice for a stagflationary environment because it's a haven, it's a store of wealth. If somehow this madness comes to an end, we go to the negotiating table, which seems highly remote, then I would suggest gold becomes less desirable. That's about the best I can do with that answer, Anna. In terms of gold itself, the hourly chart's not overbought. It is heading into this it is heading into the upper quintile. We are getting some angle and separation, but as long as it holds the upper quintile, as long as it holds the angle and separation, one would think that the bullish momentum holds. But if the stochastic falls from the upper quintile, starts heading down, I think we see a pullback in gold. That would happen if the market starts looking for bargains. I hope that helps. Anna. Unfortunately, I can't be more specific, which I'm sure is not quite the answer you're looking for, but it's kind of the best I can do. Any other questions there? It's all about if gold holds that upper quintile. All right. No other questions? Same question for oil. Katie, our same question for oil. So logically, you know, it would seem to me that at these prices, oil seems completely overpriced. However, with the just the uncertainty of potential actions that can really result in a supply shock, Katie, oil certainly would be able to go higher if the Russians just said, all right, you've imposed sanctions on us, we're cutting off our oil supply, right? They do that, then we'll see oil rise dramatically. It all depends on the, I guess it all depends on the fundamental actions, and then the technicals will follow that. So if we stay in the upper quintile, if we get that angle and separation, then the oil market moves up. The trickier, Katie, and this is unfortunately, I just want to take out the stochastic here, is we've got this strange gap here. Okay, now it's one of two gaps. Again, Katie, one of two gaps, which is not ideal because we don't know which one it is at the moment. It can either be what we call a runaway gap, or it can be what we call an exhaustion gap. Okay, A runaway gap means that everybody that thought oil was overbought before now realizes the dangers of the potential supply shock and have jumped in on an emotional trade, forcing the gap on the open. And a runaway gap will tend to continue because of the excess demand that results from the supply shock. The other option is what we call an exhaustion gap. In other words, all of the bad news is discounted in at current prices, all right, which is at 125 bucks. And if there's aggressive profit taking, the gap's going to close, and we're probably near the apex here of the move. Which one is it? That's the million-dollar question, right? I don't know. Exhaustion gaps are often confused for runaway gaps, but the truth of the matter is we still have a potential here of a supply shock because the sanctions really haven't hit oil just yet, and that can. So I don't think that is priced in. So then we might have that runaway gap. Again, I think if we can get some sort of sanity prevailing and get some sort of de-escalation, well, of course, this would probably tend towards exhaustion over runaway. Can't be more specific than that. Can we see dollar as a haven? Yeah, definitely. Dollar would be a haven. Dollar would be a haven. It's also starting to bump up here. Okay. It's also starting to bump up here. This is a weekly, not overbought. The question really comes down to, Anna, which is the haven, the dollar or gold? Dollar or gold? So the way I see it, and this again is also subject to correction, is that stagflation, gold seems to be the obvious choice. Normalization, dollar seems to be the obvious choice. Because if there's some sort of normalization, then policymakers can get back to controlling inflation. Once stagflation, once stagflation appears, there's no control over inflation, and in fact, the preferential options by policymakers, in theory, is to do nothing. Well, that means gold becomes the obvious choice. So yes, the dollar is still on the table there. It really depends how things pan out, and I want to just reiterate that is how things pan out is complete uncertain. That's complete uncertainty. That's the definition of financial risk. That's the market we're in. That's the emphasis for us. It's all about now acknowledging heightened uncertainty, heightened risk. It's all about risk management. All right. Any other questions there? All right. I'm going to conclude at this point. I still don't have power, guys, so I can see my battery is running dry. I'm pretty sure I'm hotspotting at the moment. My mobile is on 13% because I didn't charge it overnight. Anyways, I will get back online as soon as the power comes back on. Thank you very much, guys, and I look forward to chatting with you tomorrow. Cheers, guys. Thank you. Oh, hugely appreciated, and thank you very much for supporting the webinars. Thanks very much, and I'll speak to you tomorrow.